Hey guys, if you're an Australian expat and you're thinking about buying property in Australia or you already own property in Australia, stop and watch this video because what I'm about to tell you can save you hundreds of thousands, if not millions of dollars, and it's something that your real estate agent or mortgage broker won't necessarily tell you. Hi, my name is Sean Avery and I've been a leading financial consultant for Australian expats around the world for about 20 years now. And during that time, hundreds of my clients ask me one special question, and that is, Sean, why do you refuse to buy an investment property in Australia? And I always give them the same answer. It's very simple. It's because I've done the math. See, many years ago, I had saved up $500,000 and I thought to myself, you know what, Sean, buy a property. Do what your dad has always told you over those many years. Buy a property, son, buy a property. And also being Australian, it's culturally wired into my blood to obviously want to buy a property. And that's how we're wired as Aussies. We just love property. Now, me being me, obviously, I'm not just going to make the biggest investment decision of my life without doing the math. And that's exactly what I did. I pulled out the Excel spreadsheet and I thought to myself, I'm going to do the math. And I thought to myself, I'm going to make a comparison. I'm going to compare buying investment property and putting a deposit of $500,000 down versus taking that $500,000 and putting it in the stock market and buying something simple like the S&P 500. Now, I was very curious as to what would make me the most money after, say, a 10-year period. One reason being is because while living in Singapore, obviously there is no capital gains or dividend income tax. And I was very curious as to which one would outperform which, the leveraged investment property or the S&P, say, 500. Now, guys, please keep in mind, this is not financial advice. I'm not a tax accountant, a mortgage broker, or a real estate agent. The purpose of this video is just to run you through my own personal reasons of why I will never buy an investment property in Australia. Your job as an investor is to speak to your real estate agent, your mortgage broker, and your tax accountant to gather the correct information and then to do the calculation that I'm doing now. And that's what I'm going to do for you today. And with that said, let's begin with it. See, what I want to do for you right now is I'm going to go through the Excel spreadsheet of the comparison between buying property in Australia versus investing in the stock market, in particular the S&P 500. Now, when doing these calculations, it's very important that we get our assumptions right. So that's what I want to do for you right now. I'm going to run you through the assumptions of buying the property and also the assumptions of buying the S&P 500 or index. Now, when it comes to property, there are three factors that we need to take into account, not just the growth rate. We need to factor in initial costs of buying the property, such as stamp duty. We need to factor in ongoing income, rental income, also ongoing costs. And then we need to also factor in exit costs, such as agent fees and also capital gains tax. So let's go through that right now. Now, like I said, I had saved up a deposit amount of $500,000. Now, I thought to myself, I'm going to buy a property for $1.5 million. I come from Perth, Western Australia. Sure, I could buy a unit in my city for, say, $700,000, $800,000, but I've done my investigation on actual growth rates, expected growth rates of units over a period. It didn't look too good. So me being an investor, I thought I'm going to focus on buying landed property. And in Perth, Western Australia, unfortunately, you can't get anything really for less than $1.5 million. If you spend $1 million, you're probably in a not so good neighborhood. And I wasn't about to make that decision. So I thought, you know what, I'll put a $500,000 deposit down and buy something that was worth $1.5 million. Now, I needed to factor in the stamp duty on that $1.5 million. Now, depending on the state, guys, will depend on how much stamp duty you have to pay. It's best to talk to your real estate agent or your tax accountant about that. According to money.com.au, Victoria can go up to 5%, which is absolutely bonkers. But I was lucky in Western Australia, you're looking at 3.6% or 4%. Now, I've plugged that in, 4%. Now, when it comes to growth rates, this is obviously going to be a touchy subject for some people. But according to prosolution.com, if we actually look at the national house price across the top 5 capital cities, over the past 2 decades, it's only been 5.3% growth. Now, I know Sydney and some markets had some phenomenal growth over the past 5 years. However, it would be quite ignorant to expect those kind of returns over the next 5 years. So obviously, we're going to use a much longer time frame. I believe a 20-year period is much better to use. From 1983 to 2003, during the median house prices grew by 8.7%. Now, can we expect that kind of growth again? I don't think so. It's 5.3 right now. I'm going to be a bit more lenient and say it's 6.5% growth on property over a 10-year period. Now, when it comes to rental yield, obviously if you're buying a unit, you're going to get a much higher return. According to wise.com here, I mean, if you're looking at Darwin, units are generating 7.8%, which is quite phenomenal actually. But because I'm owning a house, I've chosen not to buy a unit because the capital appreciation on units is very low. All that needs to happen is someone needs to build a new apartment complex next door, and that's 100 more units that you need to compete with. So I've decided to stick with the landed houses. And in Perth, the expected rate of return is 4.2%. I'm going to say it's 4% because I know for a fact that a lot of my clients are only getting 3%, so I don't know why it says 4% there, but I'm going to be generous and put 4%. Now, when it comes to interest rates, here on rba.gov site, it says it's around 6%. Now, the date today is the 20th of September, guys, 2025. So if you're watching this a year from now, please note that rates can obviously fluctuate. As of today, it's around 6%. I am going to use 5.5% per annum as a mortgage interest rate for that. And that's according to the RBA.com. Now, other factors that we need to factor in is obviously I live in Singapore. I'm not about to do all of this myself. I'm going to pay an agent to put someone in the place and take care of it and do inspections and all of that. And according to Host.com, here we can expect to pay 5 to even 12% per annum. If you're lucky, you can get cheaper, but for the purpose of this, I'm going to use 10%, which means that on my rental income, 10% of that rental income will go towards the management team. Now, upkeep, guys, that's something we need to factor in. Landlord insurance, mortgage insurance, we need to factor in if something breaks, water, all of these things. Now, according to cmlaw.com, it's looking at around 1 to 2% per annum on the value of the property. I did think that was a bit hefty. However, I'm going to use 0.5%. I'm going to imagine, maybe my aircon breaks once in 10 years. And 0.5% on the value of the property I'm going to be more conservative with it, makes sense. Now, when it comes to land tax or strata fees, guys, this is where you need to be extremely careful. If you're thinking about buying a unit, and I actually looked at buying units, some of the strata fees are absolutely ridiculous. $6,000 per quarter, sometimes $25,000, especially if you've got a tennis court, a pool. Absolutely ridiculous. And in regards to landed properties with no strata fees, if you're from New South Wales, Victoria, Queensland, guys, please make sure you do your investigation because you can get hit with penalties just for living overseas as an expat, which makes your property completely useless. I do have clients in these positions that are possibly looking at selling because of such ridiculous price charges. In my case, I got quite lucky. In WA, we're looking at around 2.4% land tax on the value of the property. Now, like I said, it's on the value of the land, not the value of the property. So we've actually put in the calculation that the property land would be valued at 75%. Agent selling fees. Now, when it comes to sell time, most agents charge 2%. You will need to pay an extra $10,000 or something for advertising on realestate.com or whatever it is. But let's just keep it a flat 2%. For the purpose of this calculation, we're going to use 10-year period. So what is the expected return over 10 years? And last but not least, capital gains tax. Now, this is where it can get messy, but I've done the capital gains tax calculation for myself. It is your responsibility to talk to your tax accountant about these equations and such, but I've done one for myself. And on top of that, guys, I needed to put the details through a loan calculator to find out the stamp duty rates and how much extra I had to fork out. This is the loan calculator, how much extra I had to fork out from my pocket every single year to cover the mortgage, because obviously the rent isn't going to be enough. So those are the assumptions for the property. Now, what I'm going to do is I'm going to walk you through the assumptions for the S&P 500. Now, instead of taking that 500,000 and putting it down as a deposit on the property, we're going to put it into the index. And let's talk about the growth rates. Now, if you just go on google.com, typed in S&P 500, it'll pop up and it will show you that the return over the past 5 years was absolutely bonkers. It's 88.27%, which is absolutely crazy returns. But like the Sydney property market, I'm not going to use the past 5 years as any indication that that's kind of going to happen going forward. It's best to look at things from a 20-year timeline. Now, if we look at this map here from First Trust, it says here that the average annual total return of the S&P 500 index for the period shown below from 1970 to today is 10.83%, and that's going through all the ups and downs. That's the average expected return. Now, if we go further, look at other sources, nerdwallet.com, Investopedia and such, say that the approximate return is 9.7 or even 10% per annum. So in regards to this, I'm going to put in 9%. I'm going to be more conservative and not put 10%. I'm going to put 9%. Now, when it regards to entry fees, there is no entry fees into the stock market, which is great if you're using the correct platforms. There is no exit penalty in most situations. Again, that depends on the platform that you're using. And capital gains tax. Because I live in Singapore, there is no capital gains or dividend income tax. And it's the same if you're, say, in Dubai or, say, Hong Kong or even Switzerland, no capital gains tax. Now, even if I moved home to Australia, it's still going to be nil capital gains tax because I would use an investment insurance bond structure. And that will eliminate the capital gains tax after 10 years of ownership. If you want more information on those insurance bonds, please click the link. It's probably the best solution for Australian expats in the entire market. And if you don't know about it, you definitely should. Now, management fees. You can buy an index fund from Vanguard for hardly anything. So I'm actually going to put the management fee at nil. Again, depending on what platform you're using, right? So now that I've plugged all of these assumptions in, it then flows across into the Excel sheet. So that's what I want to do for you right now, is I'm going to go over to the Excel spreadsheet. Now, as you can see here, it can be very complex. Guys, I am not going to go into too much detail. For those who really want to understand the inner workings of this calculator, please, by all means, click the link and book a complimentary meeting with me. I'm more than happy to run you through the equations and everything that you need to know. It's quite advanced, so I'm going to keep it quite simple, right? Over a 10-year period, with a growth rate of 6.5%, we can expect to sell that property at $2.8 million. Now, if you told someone, I bought a property for $1.5 million and 10 years later sold it for 2.8, most people would say, wow, that is a really good investment. And this is where most people get it wrong. They don't really factor in all the other costs, the initial, ongoing, and the exit costs to find out the real return. They just think, that is my return. That's obviously not the case. We've actually had to calculate the loan balance, how much strata fees are, again, the rental income, the estate agent fees, the upkeep fees, the land taxes, the loan interest rates, and on top of that, the principal payments that we needed to make for the mortgage. And as you can see here from this calculation, I've actually had to fork out $54,000 every single year to cover the rest of the mortgage because the rental income wasn't enough. Now, I was prepared to do that. I can afford, I've got a surplus above $4,500 per month, so I can actually afford to do that. And guys, if I lived in Australia, it wouldn't be too bad running a negatively geared property because in most cases, you can deduct, if you talk to your tax accountant, they should be able to deduct most of those losses or most of those forked out money from your salary income in Australia. I live in Singapore, so obviously there is no point in trying to claim any income because I merely can't. So moving forward, those are the ongoing steps. We needed to calculate the capital gains tax. And like I said, guys, this is my own personal calculations. Under no circumstances should you make any investment decision based on this. I'm not a tax accountant. It is your job to find out how much tax you will pay. Now, I've calculated the tax just for my own personal reasons. And on this property itself, my tax, the total taxable gain that I would make would be 1.1 million. The total amount of tax I would have to pay is $520,000 or 43%. Now, guys, that is a hefty, hefty bill to pay on tax. $500,000, sheesh. Now, that is a rate of 43.35% that I'm paying in tax. And the reason being is obviously because I don't get the capital gains tax discount while living overseas. In fact, even if I moved back into it before selling it, I still wouldn't get that discount because you can't wipe out the history of being an expat. So the charge was very steep. Now, if I lived in Australia during that entire time, my tax rate would have only been 20%, not 43%, which is a huge difference. So now that I've run you through the calculations for the property, we can now figure out what is our real dollar value return and what is our real percentage return on investment. But before going through that, I'm going to run you through the S&P 500. The S&P 500 is very simple. There's no entry fee, ongoing cost, so it's a much more simple equation. You put in $500,000 and then you grow that at 9% over a 10-year period. However, we still needed to factor in that money that we needed to pay for the mortgage, that we had to take out that $4,500 per month to pay off the mortgage. Well, we also needed, for a true like-for-like comparison, is to factor in that money went into the S&P 500 for a true like-for-like comparison. And that's exactly what we did. So we added the total top-up amount of $484,000, just in the same way, and I'll move over to the other spreadsheet, that we added $484,000 to the property. So it's a like-for-like comparison. Now, let's look at the actual outcome. Guys, the property of over a 10-year period, if I bought a property in my suburb of Western Australia, Perth, under those assumptions that I put in, I can expect to make only $381,000 return. Versus the S&P 500, which I would have made $950,000 return, giving me a difference of $568,000. From a percentage point of view, it gets even more disturbing. My growth rate on investment that I put down would only be 38.77% return versus 96, almost 100% return for the S&P 500. Now, guys, keep in mind, I haven't factored inflation. If I did in factor inflation, obviously the annual cumulative return would be a lot lower. It would be almost 0%, meaning if I bought property in Australia 10 years ago when I was looking at, I would have nearly just broken even. While in the S&P 500, at least I'm getting some kind of return. I've made $950,000. Now, guys, I don't know about you. I don't know your financial position. But for me, losing an opportunity cost of $568,000 over a 10-year period is absolutely no joke. And that's one of the reasons why I will never buy property in Australia while living overseas anyway. Now, guys, keep in mind, these are just the economic decisions that I've made, the mathematical, monetary reasons why I've decided not to buy property. I haven't even factored in the no liquidity. For instance, if I invest in the stock market, I come into emergency, I can sell that stock immediately within a second and have that money in my bank account within a day or two. So liquidity is a huge thing. Number thing is the time and stress that it takes, the time of dealing with agent fees, real estate agents, mortgage brokers, making sure there's someone in the house and so on, the emotional stress and such, someone breaks something in the property or someone decides to squat, I haven't factored these reasons in. Those are additional reasons that you need to think of for yourself. I'm really talking from a mathematical perspective. And that's exactly why I've decided never to buy property in Australia. So now that I've gone through these mathematical equations and spreadsheets with you to show you why I've personally decided not to ever buy property in Australia, what does it mean for you? It means nothing. You should make your own decision when it comes to buying property. I don't know your current personal situation. I don't know if you're going to move back in the property next year or in the year after. I don't know if you want to send your kids to go to school. I don't know if you've lived in the property. The purpose of this video is to really just show you how to think when it comes to making any investment decision. And what you should be doing is obviously doing the math. You should be talking to your real estate agent, your mortgage broker, and your tax accountant to go collect all that information and put it into the Excel spreadsheet. Now, guys, you can't expect your mortgage broker or real estate agent to do this for you. They're absolutely not going to do this for you. Their job is to sell you a property or to sell you a mortgage. This is your job as an intellectual investor to do the math yourself. Go seek that information. Now, does it mean you shouldn't buy property? Absolutely not. I am not anti-property. I just bought a villa in Bali. It's a beautiful villa with a rice field, and I absolutely love it. Does it make sense from a monetary point of view? Absolutely not. It's not going to generate me a good capital gain over 10 years or for the leasehold. It does generate me quite a good considerable income when I rent it out on Airbnb. However, from a monetary perspective, it's a bad investment decision. The reason why I bought my Bali villa is because I live in Singapore and it satisfies my lifestyle. No one goes out there to buy a yacht or a Ferrari to hopefully sell it in 10 or 20 years' time to make a profit. You buy it because you've worked so hard and you want to enjoy it. You want to enjoy the emotional and spiritual returns that it gives for you when you buy that asset. And that's your job, is to define the reason for purchase. Now, if you need help with any of your financial planning decisions, please, by all means, click the link below and book a complimentary free 30-minute or 1-hour video call with me. I'll be more than happy to help point you in the right direction. Again, like I said, this is not financial advice. This is my own personal decision. Your job is to seek the correct professional advice before making any investment decision. I hope to see you soon. Have a great day.